The International Monetary Fund has disclosed that the federal government may lose as much as 0.5% of the country's gross domestic product in revenue following its decision not to raise the value-added tax rate. Welcome to Business Point. It's a program that extracts the Nigerian economy and the government policies. I am Kike Lomo Okere. In the latest International Monetary Fund Article 5 consultation report on Nigeria, the IMF stated that although the recent tax reform approved by the National Assembly and President Bola Ahmed Tinubu represents a major step forward in modernizing the VAT and company income tax regime, the choice to maintain the current VAT rate would lead to an immediate revenue shortfall, saying that the decision not to raise the VAT now is reasonable, given high poverty and food insecurity, and with cash transfer system to support the most vulnerable household not yet fully rolled out. However, this will reduce consolidated government revenue by up to 0.5% of GDP in the authorities' estimate, while the federal government is expected to largely insulated from the fallout thanks to expected gains from the improved CIT compliance, and blow will be felt most by the state and local government. According to the fund, unless alternative financing options are found, subnational governments may be forced to either scale back spending or ramp up their own revenue effort. IMF, however, acknowledged the government's justification for delaying a VAT hike, particularly at a time of worsening poverty and food insecurity, with only 5.5 of the targeted 115 million households reached under the federal cash transfer program. The fund also noted that raising VAT at this stage could further strain vulnerable households. Nonetheless, it cautioned that the cost of delaying reform would fall on already stretched public finances, especially at the subnational level. Despite these challenges, IMF also welcomed the tax reform agenda being driven by Presidential Committee on Fiscal Policy and Tax Reform, describing it as a critical to reversing Nigerian poor revenue to GDP ratio, one of the lowest globally. The reform aimed to boost compliance and enforcement, and the fund believes they hold significant medium-term revenue potential once fully implemented. Measures include modernizing the VAT and CIT framework, tightening exemption, and introducing digital tools to monitor compliance. Total revenue and grants reached 14.4% of GDP in 2024, up from 9.8% in 2023, buoyed by currency depreciation and improved administration. However, public debt also rose, hitting 52.9% of the GDP last year, with interest payments in consuming 41.1% of the federal government revenue. The IMF advised the government to maintain a neutral fiscal stance in 2025, stressing that revenue shortfall should not lead to excess borrowing. It also urged the authorities to clearly set out a medium-term revenue plans, including timeline for further tax policies change to restore investors' confidence and ensure policy credibility. The reports also pre-committing to an implementation timeline for further policy measures in an updated medium-term framework will support fiscal sustainability and provide guidance on available fiscal space for development spending and support for the most vulnerable households. The IMF also observed that while reforms since 2023, including fuel subsidy removal and the liberation of the foreign exchange market, have improved microeconomic stability, their benefits have yet to trickle down to most Nigerians. With inflation still elevated at 22.9% as of May 2025, and poverty level worsening, the government appears to be prioritizing stability over revenue acceleration. However, IMF warns that the long-term cost of inaction could be higher if reforms stall or if subnational governments struggle to adjust. In the meantime, the IMF continues to support Nigerians' reform efforts, including through capacity development and the deployment of a resident advisor to assist with revenue mobilization strategies. It could be recalled that the Nigerian Economic Summit Group warns that the federal government could face revenue shortfall if it does not increase the value-added tax rate as part of the ongoing tax reform process. The Chief Executive Officer of the NESG, Dr. Tayo Aduloju, made the statement during an interactive media session in Abuja. He emphasized that while reform in the VAT system are essential, maintaining the current VAT rate without an increase could lead to a significant loss of revenue for the government. Speaking on the issue, Aduloju says without those rate hike, it means that the government might lose some revenue. Aduloju explained that the current tax reform process must strike a balance between simplifying the tax system and increasing the VAT rate to maintain revenue stability. According to him, simply reducing the number of tax without adjusting the VAT rate could weaken the government revenue base. The Nigerian-US exports plummet by $527 million amid rising trade tension. Other Nigerian exports, including agriculture, manufactured goods, have been affected by uncertainty generated by the new trade policy. This shift is evident in the trade data, which shows that the U.S. imports from Nigeria in May 2025 stood at $400 million, a sharp drop from $517 million recorded in May 2025. More importantly, oil shipments, though not subject to tariff, have shown signs of weakening, possible due to market dynamic and shift U.S. sourcing strategies. Data from the first 5 months of 2025 shows that the U.S. imported 17.39 million barrels of Nigerian crude oil, valued at $1.34 billion based on custom value. This marks a drop from the 20.4 million barrel worth about $1.52 billion imported during the same period in 2024. The decline in the volume suggests a shift in U.S. sourcing, perhaps reflecting competition from other producers or strategic reserve adjustment. Despite the drop, Nigeria remained the largest supplier of crude oil to the U.S. from Africa, ahead of the Libya, Angola, and Ghana. In May 2025 alone, the U.S. imported over 4.2 million barrels of Nigerian crude, valued at $311 million, down from $368 million in April. However, crude oil imports from Nigeria alone accounted for 62% of total U.S. crude purchase from Africa in the first 5 months of 2025. By value, Nigerian oil exports to the U.S. stood at $1.34 billion, which is custom value, and $1.38 billion, which is CIF value, reflecting its central role in the energy trade, even if the overall exports have declined. The rest of the Africa contributed $811 million in crude oil exports in the same period, with Libya, Angola, and Ghana trailing far behind Nigeria in both volume and value. The limited diversification of its export basket, coupled with structural constraints such as port inefficiency, regulatory bottlenecks, and weak industrial capacity, has curtailed Nigerian ability to expand beyond crude. It is important to note that the U.S. also maintains a strong export relationship with Nigeria in the automobile sector. Data shows that in the first 5 months of 2025, the U.S. exported $426 million worth of motor vehicles fuel and part to Nigeria. This includes $312 million worth of passenger cars, $29 million worth of trucks and buses, and $86 million in parts. This sector alone accounted for nearly 18% of total U.S. exports to Nigeria, highlighting the importance of the Nigerian consumers market for American manufacturers. 8 Nigerian banks incurred a combined of 156 billion naira in payment charges on credit and financial assets in the first quarter of 2025, according to analysis on the unaudited financial statement filed by the Nigerian Exchange Limited. Recently, the impairment charges often refers to as loan losses or credit losses, which reflect provisions set aside by banks to cover potential default and deterioration in the value of their financial assets. The figure represents the cost of risky lending and exposure to a volatile macroeconomic environment, including inflationary pressure, naira depreciation, and constrained consumers and business liquidity. A bank-by-bank breakdown of the data shows varied exposure of level and provisioning strategies, with some bank reporting significant decline in impairment charges while others recorded notable increases. In the period under review, Zenith Bank recorded the highest impairment charges among the 8 banks, posting 49.38 billion naira for the period ended March 31st, 2025. This marks an 11.8% decline compared to the 55.97 billion naira reported in the same period of 2024. The drop may be attributed to improved asset quality or aggressive loan recovery efforts within the bank. A breakdown of the total expected credit losses in the first quarter of 2025 shows that loans and advances accounted for 35.95 billion naira, while investment security accounted for 7.1 billion naira. Treasury bill accounted for 2.16 billion naira, and other financial assets and due from banks accounted for 1.87 billion naira and 2 billion naira respectively, also contributed to the provision. Despite the high provision in Zenith delivery, a bottom line growing its profit after tax by 20.7% from 258.34 billion naira to 311.83 billion naira. First Holding Company followed with a provision of 37.25 billion naira in the first quarter of 2025, down by 11.2% from 41.93 billion naira posted in the same quarter of 2025. The impairment losses was primarily driven by an increase in provision on loans and advances to customers, 41.23 billion naira, with marginal contribution from bad debt write-off 8 million naira, offset by reversal in other assets, which is 3.9 billion naira, and off-balance sheet item, that is 95 million naira. Despite the provisioning, profit for the period stood at 171.10 billion naira, a decline from 208.11 billion naira in the first quarter of 2024. Access Holding reported a net impairment charges of 21.77 billion naira, representing a 4.5% decline from 22.79 billion naira reported in the first quarter of 2024. The reduction was partly due to absence of impairment write-backs on pledged assets and a decrease in charges on investment securities for fair value through other comprehensive income. This slight improvement suggests a tighter risk management and credit monitoring practice. These modest improvements, combined with cost control and income growth, profit tax to 108.7 billion naira from 159.29 billion naira, a year-on-year increase of 14.7%. Guaranty Trust Holding Company declared a loan impairment charge of 13.42 billion naira, slightly down from 13.49 billion naira in the same period of 2024, translating to a 0.5% drop. The relatively stable impairment level suggests consistent asset quality with the group credit portfolios. The breakdown shows that the majority of the impairments arose from stage 3 loans considered credit impaired, for which the bank provided 14.56 billion naira. In contrast, some recoveries and reversal from stage 1 and stage 2 loan helped to offset the total. However, profits after tax fell sharply by 43.6% from 457.02 billion naira in the first quarter of 2024 to 258.03 billion naira in the first quarter of 2025. United Bank for Africa recorded a total impairment charge of 14.18 billion naira in the first quarter of 2025, up from 3.28 billion naira in the first quarter of 2024, representing a sharp 332.2% increase. Increased allowance for the credit losses on loan of 11.12 billion naira, an additional provision on investment securities, placements and other financial assets of 3.06 billion naira drove this rise. The spikes indicate heightened credit risk within its lending and investment portfolio, potentially tied to microeconomic challenges or foreign exchange exposures. Despite this, the bank achieved a 33.1% growth in profits after tax, moving from 142.58 billion naira to 189.84 billion naira. FCMB posted an impairment charge of 9.52 billion naira in the first quarter of 2025, a notable of 59.9% drop from the 23.71 billion naira recorded in the corresponding period of 2024. This decline was primarily due to substantial recovery on previously written off loan, which amounted to 4.11 4.11 billion naira. Loan and advances impairments dropped significantly to 12.69 billion naira from 23.96 billion naira, while recoveries and fair value adjustment offset overall provisioning level. Profit after tax improved to 32.23 billion naira, up from 28.77 billion naira. Fidelity Bank reported an impairment charge of 8.66 billion naira in the first quarter of 2025, marking a 285.8% increase compared to 2.25 billion naira in the first quarter of 2024. The bank statement shows that the impairment was combined with depreciation and amortization, indicating a broader asset write-down during the quarter. Wema Bank posted a total of impairment charge of 1.82 billion naira in the first quarter of 2025, up from 64.7% from 1.10 billion naira recorded in the same quarter last year. The increase reflects rising provision on loan and advances 1.04 billion naira, investment securities 51.78 million naira, and other assets, which is 411.23 million naira, with some offset from recoveries of 272.02 million naira. The spike in provision points to expanding risk exposure as the bank grows its loan book. In total, the 8 banks incurred 156 billion naira in impairment charges in the first quarter of 2025, compared to 164.53 billion naira in the same period in 2024 from revised estimated, indicating a 5.2% decline overall. However, while the aggregate number dropped, individual bank performance varied significantly. The trend reflects both uneven impact of the macroeconomic volatility on credit portfolio and the differing risk strategies adopted by banks. Alright, let's take a quick short break. We'll be right back. Don't go away, stay with us. Welcome back. If you're just joining us, this is Business Point on Global Television. It's a program that's extracts the Nigerian economy and the government policies. The Naira on Monday surged to a 4-month high of 1,518.88 per dollar at the official foreign exchange markets, driven by improved liquidity and a moderation in demand for the greenback across FX window. The last time the Naira traded a stronger level was March 14, 2025, when it closes at 1,517.93 Naira per dollar. By the close of trading on Monday, the local currency had appreciated by 0.74%, gaining 11.38 Naira from Friday's rate of 1,530.26 Naira per dollar at the Nigerian foreign exchange market. According to the data published by the Central Bank of Nigeria, in the parallel market, also known as the black market, the Naira held steady at 1,545 Naira per dollar, the same level it closed the previous week, reflecting relatively calm despite fluctuating market dynamics. The Naira recovery came in spite of a decline in FX inflow last week. According to a report by Coronation Merchant Bank, total FX inflow fell at $749.8 million from $1.76 billion the previous week. Nevertheless, foreign portfolio investors remain dominant, contributing 46.13% of total inflow of the 8th consecutive week, a trend seen as a reflection of sustained interest in the Nigerian fixed income assets. Alright, this is where we'll call it a wrap on Business Point today. Join me again tomorrow on Global Television on DSTV channel 365 and 276 on Star Time. You kindly follow us on all our social media platforms. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.